Well, greetings and welcome to the investment strategy brief for December 2024. As I sit here today, this last session of the year, I want to take a look back at 2024 a little bit, a look forward into 2025, and really think of it as a shift from this year into next year. That'll be the topic. Thanks so much for listening this year. And let's kind of jump into it. The first thing I want to get into is politics and geopolitics. So first up, of course, is the election and sort of what's been going on with the transition in D.C. So we know, to look back at November, that it was a Republican sweep with Trump retaking the White House and then Republicans taking both parties of Congress, granted with a narrow majority, and that's going to play into things. But when we take a step back and look at the various topics in focus as it relates to a transition, and little updates and just a reminder. So deregulation is what we would expect out of the Trump administration, sort of unwinding some of the regulations put in place by the Biden administration. That's going to certainly be an improved situation for financial services and companies more broadly, maybe not having to focus quite as much on climate, for example. We by the way, we expect there to be a little bit of an increase in mergers and acquisitions as a result of all that, so a little bit business friendly. Taxes, we would expect there to be an effort to extend at least some of the 2017 tax cuts and maybe look for other ways to cut taxes. And again, that narrow majority in Congress is going to play a role with that. With healthcare, we know that RFK Jr. has been nominated to be the Secretary of Health and Human Services. If that in fact happens, he's approved by the Senate, then we'll see some big changes, some big focus. Either way, we would expect a fewer regulations, sort of a deregulation focus in healthcare as well. With the military, we know that President Trump is in favor of a strong U.S. military, so spending will probably remain in place, but he has campaigned on the idea of being able to go and negotiate peace in some of the military hotspots around the world. We know he'll take an aggressive approach, an America-first approach to foreign policy. He'll use tariffs as a mechanism to negotiate. It's been interesting to watch that world leaders are already spending time with him and engaging and reaching out, and knowing that he's going to be assertive, and countries and leaders wanting to, sort of strengthen and maintain in some ways a relationship with the United States. On the energy front, we know that there will be a shift back to more traditional energy from alternative energy, although, as we said last time, we would expect nuclear energy to play a key role. Since I think our last session, President Trump has proactively mentioned that he doesn't have an intention of asking Fed Chair Jerome Powell to step down, so Powell would at least play out his current role as the chair of the Federal Reserve. And then, of course, in focus with the Department of Government Efficiency, DOGE is government spending, just trying to do things more efficiently. All of that has added up to this sense of business-friendly and sort of positive environment. So animal spirits generally are up a little bit since the election. Now, what I've attempted to do, my team and I have attempted to do this time around, is to put together this exhibit to kind of give us a visual on the nominees for different positions in the administration. And it's color-coded, so think of it as the box for each individual. The box on the left is basically intended to signal experience. So a really deep green color would mean a lot of experience. White would be sort of in the middle, and then a deep yellow would be, hey, no experience at all. Then the second box, the one on the right for each individual, is our take on the feasibility of the nominee getting approved. How clear do we think it is for them to get approved by the Senate? And so when you look at nominees like Marco Rubio for Secretary of State, or Pam Bondi for Attorney General, or Scott Bessent for Secretary of Treasury Secretary, those look pretty clear. The four where we see some challenges potentially would be Pete Hegseth for Defense, RFK Jr., as I mentioned, for Health and Human Services, Chris Wright for Energy, and Kash Patel for FPI. Not that they aren't going to happen, but it's going to be a much more sort of focused and a kind of intense process for them to go through with the Senate to get approved. Now, to put some historical context to it, since the early 1800s, there have been 9 nominations formally rejected by the Senate, and then 19 nominations or near nominations where either the candidate themselves withdrew or the president asks them to withdraw before a vote. So anyway, this is just giving us a sense. All this does, I think, it gives us a takeaway that the bulk of these nominees should get approved, is the punchline, knowing that there's the four that we've identified where we think there's going to be some challenges. Now, focusing out a little bit further on the geopolitical environment, there are three areas that I just wanted to mention in this session. The first is France. So we know that now former Prime Minister Michel Barnier basically put forward, probably almost as a political move, a strategic move, a fairly aggressive budget. So think big spending cuts, big tax hikes, really to reduce debt. And that was met negatively, basically to the point of a no confidence vote. He's out. So President Macron has appointed a longtime ally Francois Bayrou as the new prime minister to navigate economic challenges that are there as a result of all of this, and what really is a fractured legislature. Anyway, second up, South Korea, the idea of martial law. So President Yoon declared martial law over alleged anti-state activities by the opposition, but really lawmakers pushed back immediately, annulled it, and now the president's facing a backlash and impeachment threats, and so Yoon formally rescinded the order. But and in some ways, some would say averting a major crisis, but really it was a political crisis and, frankly, some market disruption as a result of it. In any event, the third is as I think everyone knows, Assad in Syria. Basically, rebels seized Damascus, so Assad's decades-long rule has ended. He's fled to Moscow, and actually this whole thing has brought into focus questions about regional stability and the role really that Syria has had with Russia and Iran in terms of some of the challenges and tensions in the region. So anyway, that's what we wanted to get into with politics and geopolitics. Now let's turn to the economy. So we know from our earlier discussions that we've talked a lot about artificial intelligence being sort of an anchor and a thread through many of our long-term themes. And, we know that it's sort of propagating across the economy, and yet it's really, really early days. But we've mentioned AI on and off really as one important input sort of to the optimism of what's going on in the economy. And ultimately, when we look at the trend growth for the GDP itself, we've seen once again that GDP has grown above trend. Better than expected for sure as we started the year. And in fact, we're just reminded here on page 11 that the consumer makes up about 2/3 of the economy. We've done our thing of sort of checking earnings releases and the transcripts of earnings calls with CEOs around the country, really in this case. And what we found is a pattern that showed itself last time, but it's reinforced here, which is there are some retail-facing companies, so think of it as companies selling services to consumers, where many CEOs are pointing out what they sense as a stress, if you will, some tensions with consumers. But there's a specific pattern to it, which is it's lower-income folks living on a tighter budget, where it's pretty clear that inflation has been difficult for them in the current environment, and honestly, higher rates means higher costs of debt on credit cards, things like that. So they're feeling the pinch. For folks that are a little bit better off and have a little bit more discretionary spending or savings to spend, the spending has continued, right? So a little bit of cracks with the consumer. And then, bottom line is we see retail sales jumping around, but remaining reasonably positive. We are seeing an increase in the interest costs on debt. We're seeing a modest, not alarming yet, but a modest increase in delinquencies, as we talked about last time. But check out the graph on the bottom left here of page 13. Basically what this is a metric that is a consumer sentiment, but looking forward, sort of an expected view. And here it's basically broken to political party between Republicans and Democrats. And the punchline here is that people along party lines tend to be optimistic when their person's in office and less optimistic when they're not, right? So you see the period of roughly 2016 to 2020, Republicans are feeling pretty good, 2020 to 2024, Democrats are feeling pretty good, and then the flip back in the wake of this most recent election. Now, moving on to, as I mentioned, the idea of monetary policy and inflation. So here we have our regular chart on monthly consumer price index and producer price index inflation. These are 3-month rolling averages. The green line represents the monthly equivalent of the Fed's 2% target. And what you can see pretty clearly on the right side of this chart is all those little bars are moving up a little bit above that green line. What does that tell us? It tells us that inflation is firmed up and it's running a little bit above the Fed's 2% target. So it brings into question exactly when and how quickly the Fed will continue to cut rates. Now, when we looked back to late September, as I think we talked about the last couple of sessions, basically people were really optimistic. Since then, while there continues to be almost, I think it's a 98% view based on Fed funds rate, 98% probability that there will be a 1/4 point cut at the December meeting. By me recording this, it's actually next week that the Fed's going to meet. And then interestingly, over the course of 2025, think 2 1/4 point cuts, so just another 0.5% through next year. When we look at, and that's the greenish line, when we look at the blue line, basically that's the optimism of more rate cuts embedded in those futures contracts right after that first 0.5 point cut. And essentially it adds up to round numbers, another 1% that was expected. So it's almost like when we first saw that happen, that we thought there would be more cuts this year and more cuts next year, and the Fed's backing off of that. Now, why is that important? That's important because higher rates for longer means the cost of debt remains elevated, right? And so whether it's the consumer, as we've discussed, the headwind for businesses, and then very importantly, our federal budget, our federal debt, that higher rates really means a higher cost of debt, which is a real burden on people that have borrowed or entities that have borrowed money. So the numbers we've updated here, you can see the 10-year Treasury as we record this is around 4.2, 4.3%. Forward rates remain embedded in the curve, indicating that the market thinks rates will remain higher 10 and 20 years out at these levels and maybe a little bit higher. And then the buildup of debt is pretty notable. We are now over $36 trillion for the U.S., and that's in part the result of the $1.8 trillion deficit we're operating on this year. And that translates to this idea of servicing that debt, 35% of our discretionary spending going just to pay the interest, right? So as we've talked about before, we've seen corporate leaders weigh in and say this is unsustainable. We've now seen Fed Chair Jerome Powell weigh in and say it's unsustainable. And then, importantly, the incoming nominated Treasury Secretary is also saying, hey, this is something we have to focus on. So again, between DOGE and sort of the spending focus, efficiency focus, and sort of the awareness of this from the incoming Treasury Secretary, we view all of that as challenging but positive in terms of renewed focus on the issue. As it relates to GDP overall, as I mentioned, this has been a very positive year, and so well above trend is where it looks like things are going to land for 2024. And then when we look at 2025, basically the forecasts have risen a little bit so that the overall consensus view is we're going to be right at trend at 2.1% next year. That dot, by the way, is what the consensus view was as we started the year, around 1.7%, right? So there's just been an improved outlook as we made our way through the year. Now, turning to markets, we always like to sort of start with interest rates. And I think importantly, what you want to look at in this blue line is basically where the current Treasury rates are roughly. And what's happening is, and you can see it as a shift from that green line, basically the shorter interest rates have been falling as the market has seen Fed rate cuts and expects more, right? And so normally, in a sort of an average market, the shorter end of the yield curve, the dots on the left for each of these lines tend to be below the ones on the right. So there's sort of a desire from investors to earn a higher yield if they put money to work longer. And so the fact that we're seeing the short end of the curve come down is notable and I think important. It sort of reflects a healthy environment. And it does reinforce the opportunity to take a look at fixed income investing. And when you're a long-term investor, if you're especially invested in cash, this is a good time to be looking at getting that money back to work if it's within fixed income, to longer maturity bonds, if it's intended to be more diversified, including equities. While you want to be measured about it, maybe dollar cost average in, it's a good time to be redeploying cash at this point as those rates come down. So fixed income yields overall remain elevated, and you can see that they've sort of firmed up recently. So again, good investment opportunities looking forward in fixed income. And then the same pattern we've seen more generally in the equity market has been maintained. We'll look at returns in just a second, but think of it as PE ratios being elevated. So based on the forward-looking, this is the 2025 earnings per share estimate, the consensus on the S&P 500, basically in markets trading at a level that's about 22 times earnings. So that PE ratio of 22, that's about a 27% premium to the 10-year average. That's a big premium. Now, one thing to note is when we look at the average stock, the equal weighted index, the premium is very small, 1%. So markets overall, the individual stocks are more fairly valued, but the more cap-weighted index is very richly valued, meaning that the bigger companies, especially tech-oriented companies, have posted very strong returns. And so one analysis that I wanted to update, because there's been a little bit of a shift, is recall that we looked at this idea of saying, look, we're going to look at the Mag 7, the big tech-oriented stocks, and then the rest of the market, and try to understand their valuation levels, right? And it relates basically to earnings growth. So you can see 2024 is expected to be a very big year for the Mag 7 and an okay year for the rest of the companies. But when we look out to future years, the Mag 7 growth rate is falling, or has fallen, and the rest of the market, things are more positive. So when we look at that, and then we take the current PE ratios and we normalize those two things to what's called the PEG ratios, so PE divided by growth, normally what we've seen through this year is that those PEG ratios end up being the same. But what you can note is that the Mag 7 PEG ratio has gone up a little bit. And so that's telling us that part of the market is a little bit overvalued, and in part it's because the expectations for future growth have fallen a little bit. So you can see that little dot above the blue bar in the upper right side of this chart. Basically, that's the future growth rate estimate from analysts. And, it almost hit 24% for the Mag 7. That's fallen to 16%. That's a big move down. So therefore, when we look at that PEG ratio, that is in the denominator, basically the arithmetic of it would say, hey, the PEG ratio goes up. It's a signal that the Mag 7 relative to the rest of the market's a little bit overvalued. That will translate, in our view, all this will translate to a broadening of earnings growth next year. So you can see, as we've seen before, sectors like healthcare and industrials and materials, where analysts in those various segments are expecting their companies to grow at, round numbers around 20% next year. So the broadening out of the market, which we think is very healthy. And as we kind of come back and look, therefore, at returns, we added just a pure 2024 year-to-date column, sort of the third column from the left here. And so you can see the S&P 500 up very strong, the equal weighted index, which adjusts for those big tech-oriented companies, basically still up to a decent number, 17.5% by this printing. But if you follow it down about 2/3 of the way down, you'll see the Magnificent Seven index from Bloomberg, up over 70% year to date in 2024. So it's been a very, very good year. Final point on this page, far right, as we looked at last time, is the animal spirits in the market in the wake of the election remain positive. So the market's up pretty firmly since the election, and that is true for a variety of these indices, right? The S&P, the equal weighted, the financials sector, the regional banking index, et cetera, et cetera. So again, just reasonably strong U.S. performance since the election. We are mindful, as we've talked about before, of potential headwinds, especially with these elevated valuations in the equity market. So the idea of escalation, let's say that Trump goes for peace, doesn't get it, there's escalation in these wars. We have to be mindful of those risks. We have to be mindful of Fed policy error risk. We have to be mindful of the economy slowing more than expected, earnings maybe not growing as much as expected. All of those things would be little cracks that would shake investors' confidence. And so, we're watching economies. And then finally, that fiscal trajectory. So any of these things could kind of shake confidence, soften the animal spirits, and that could create increased equity market volatility and potentially a down move in the market. Now, looking forward, I did want to take the opportunity to mention that our formal outlook for 2025, we always do this. We publish it as we start the year. So the first full week of January, the middle of that week is January 8th, Wednesday, and that's our target date to release our report. We'll have a video with that report. We'll have a client webinar around that time, and then you can see just the article, not all, but most of the articles that'll be in this publication. So we'll look back at 24, our outlook, our formal outlook, an outlook on DC, this 4 Ways Forward Crossroads article is a little bit about U.S. and China. Geopolitical Risk Dashboard looks more broadly at the geopolitical environment. And then I think it'll be a fun article, basically a look at what we might see in the world in a decade related to our long-term themes. And then, of course, our allocation insights, how that all translates to investment considerations. So listen, thank you so much for checking out this session and also for watching through the year if you have, and we'll look forward to bringing you more in 2025. I always like to close with just a reminder, stifelinsights.com is a place to go if you want to check out this work. So again, thanks so much, and we'll see you in the new year.